Morning, everyone, and thank you for joining us today for this webinar where we'll discuss the state of US private debt markets with a particular focus on the direct lending market. We'll briefly discuss the Barwon Global High Income Fund, which invests primarily in US listed loan funds. And Bob and I are also delighted to be joined by Art Penn, founder and managing partner of Pennant Investment Advisors. Pennant Investment Corp, which Art and his team manages, has consistently been a holding in our fund. After a brief update on the fund and the market, Bob and I will interview Art about his experience in the private loan market and the current state of that market. Now, most of you on today's call will be reasonably familiar with Barwon, but to provide a quick update on the firm and an introduction to those who are new to Barwon, we are a Sydney-based boutique investment management firm with a focus on alternative assets. We have a team of 41 people and manage a total of 2.7 billion Australian dollars across three broad strategies, being healthcare property, property finance, and private equity. And it's within the private equity team that this high income strategy sits. Our clients include large Australian and international super funds and pension funds, family offices, high net worth individuals, and wealth management groups. On your screen, you'll see a graphic highlighting the key features of the Barwon Global High Income Fund. The key objective of this strategy is to pay a healthy running yield with a target distribution of close to 8%, with the potential for incremental capital growth. Now, depending on your definition of risk, we view this strategy as having a very favourable risk-return profile, noting that historical loss rates among middle market private loans have been considerably lower than loss rates for high yield bonds or broadly syndicated loans. However, if you take a different view of risk on the basis of capital volatility, then it is a slightly different story, in that the trade-off for that liquidity in these securities is that being listed, they do exhibit a level of equity market beta. Now, that beta is considerably lower than 1 in normal market conditions, but in periods of stress, it can certainly trend closer to 1. And in our view, it's definitely more volatile in these periods than is warranted by their underlying loan portfolios. And this is a feature of the listed loan market that we can touch on later. One of the key attractions of this strategy is that due to all the securities being listed, we are able to provide liquidity. We currently offer monthly liquidity and pricing on this fund, but as the fund scales, would certainly look to move to daily dealing. We hold 15 to 20 listed securities in the portfolio at any one time. So on a look-through basis, it is highly diversified, has a highly diversified portfolio of directly originated private loans. We do offer the fund in 2 unit classes, one being unhedged, the other being substantially hedged with the capital hedged back into Australian dollars. And finally, we believe that the fee basis of 65 basis points per annum with no performance fee is a compelling feature for an actively managed fund of this nature. To give a slightly clearer picture of what it is the fund is investing in, it invests in a portfolio of 15 to 20 listed funds, listed vehicles, which themselves make hold to maturity private loans. Now, primarily to US small and mid-market businesses, typically in the 10 to 100 million US dollar EBITDA range, as well as lending to cash generating commercial real estate assets, though that is a smaller element of the portfolio. And you can see a number of the high quality names on screen that are managing these types of listed loan funds. So I guess the next question is, what has been the experience of investing in the fund? The fund's delivered a total return of 7.7% per annum since launch in February 2014, primarily through the distribution of income. Now, it is fair to say the journey has been a little more volatile than would be ideal. But as we noted earlier, that volatility is the trade-off from having a liquid portfolio which can be traded and providing that monthly liquidity. Those who joined our webinar on this topic a year ago will recall that the sector was trading at roughly a 23% discount to book value, and we were highlighting we felt the sector was trading at the wrong price then. Now, that's really highlighted in that 1 year number, with sentiment having recovered and the realization that these loan books are healthy. The sector has recovered to around book value, and that's what's driven that abnormally strong 1 year total return of 47% you can see on screen. Now, at this point, I'll hand over to Bob, and he'll provide a bit more colour on the sector and the sector's evolution.
Thanks, James. I promise I will thank you everyone for joining us today. I promise not to get too into the weeds here, and of course, for those interested, we're always happy to arrange a follow-up meeting. So as James mentioned, about a year ago, which certainly to me feels like a lifetime ago now, a number of you joined us for a webinar on the discount opportunity in the sector. Our portfolio holdings, indeed the sector, was trading at over a 20% discount to NAV. And at the time, markets around the world, including the investments held by our fund, were reeling from a big risk-off trade and uncertainties from the pandemic. And we felt at the time we were able to buy listed private debt funds with a very big margin of safety. The discounts meant that even after extreme loss scenarios, there was a good chance of making money. While it took longer than we initially expected, the sector has since recovered back to pre-COVID level discounts and has been trading at close to par since about March this year. Since March last year, we've had 5 consecutive quarters of book value increase. Asset prices saw a swift stabilization and recovery. Book values in our portfolio are up a weighted average of 1.5% versus pre-COVID levels as measured at the end of 2019. Sure, there were absolutely some instances of capital loss over the past 18 months. We saw some credit issues concentrated in the sectors of retail, hospitality, even some healthcare deals. However, the broad recovery and also some equity gains in the portfolio have more than offset this. So you may ask where these equity exposures come from. Well, occasionally there's a small co-invest piece along with a loan. There may be warrants attached to a loan made by one of the direct lenders, or a prior distress situation or a distress loan where the lender gets handed the keys to the company. If we look across to the underlying portfolio now, the unrealized losses that we saw back in March or Q1 last year have by and large been recovered. There's been a lot of refinancing activity over the past 18 months at both the borrower level and the fund level. This includes extending out maturities, reducing the cost of borrowing, and entering more flexible financing arrangements. All of these measures improve the serviceability and financial strength. So with the sector now trading close to book value, I'd just like to take a moment and step back and revisit why we think private credit is an attractive asset class today. On the screen here, you'll see that firstly, there's been immense growth in the asset class, both in terms of AUM and the number of managers. Investor demand for yield has been increasing the longer we stay in this low interest rate environment we're in. Fundraising for US middle market lending, the chart on the left, surpassed $100 billion for the first time in 2020, despite the COVID pandemic. And the chart on the right, similarly in Europe, the growth in private credit and specifically direct lending has also been on a very strong upward trajectory. So what's driving this growth? Well, we think there are 3 key structural long-term drivers. The first, which is the chart on the left, is bank consolidation. So in the past, when you wanted to borrow money, there was one place you turned to, your local bank. Over the last 20 years, the number of banks in the US and European Union have halved. This has primarily been driven by an era of banking regulation, which has made lending less profitable, especially to riskier and smaller borrowers. And this has really caused a reduction in risk appetite in banks. And it's led to a rethinking of the type of lending banks want to do going forward. The biggest withdrawal of bank lending activity has been to small and medium businesses making less than $100 million a year in EBITDA. And so we've not only seen a reduction in the number of banks, but a really broad dismantling of a lot of the bank and lending infrastructure. The second key driver of growth, and this follows on from the reduction of and consolidation of banks, has been the continual decline in corporate lending. Corporate lending is now a market dominated by non-banks and private lenders. The sub-investment grade credit markets of high yield bonds and leveraged loans have also gone up in size and scale. These markets are now effectively closed to companies who want to issue less than $300 million of debt. The sub $300 million tranche size used to account for about 39% of the market back in 2004. In 2021, this sub $300 million tranche size accounts for only 2% of the market. And finally, the third driver of growth in private credit, companies around the world are staying private for longer. This is evident from the huge growth in assets owned by private equity. Global private equity net asset value has increased almost tenfold in the past 20 years, as we can see on the chart. Meanwhile, over the past 20 years, the number of public listed companies has actually halved. The ones remaining listed are bigger than ever before. In 2021, private equity transaction activity is on track for a record year. And so the tremendous growth in private equity, with more companies staying private for longer, has really been a key source of demand for private credit and demand for support from direct lenders. So this is where the rubber hits the road. Why invest in this space? Ultimately, it's in search for better risk-adjusted returns. On this slide, we show the yield across a range of asset classes today. I think the first thing you'll notice is that current yields for all asset classes are below their 5-year average. However, we continue to find that private middle market debt, which is the dominant underlying asset in the Barwon Global High Income Fund, provides a very attractive yield. The yield of 9.3% shown on screen is the income return of Cliffwater's Direct Lending Index. It's an index of over 7,000 directly originated middle market loans with over $150 billion in principal value. Now, many of these loans in Cliffwater's index are held by the managers and funds we have in our portfolio, and so our underlying investments are very similar. The weighted average net dividend yield of the holdings in the Barwon Global High Income Fund is a little lower than 9.3%. It sits today at about 8%, which is still very attractive to other asset classes. We often get the question, a premium yield, but what risk are you taking to get this yield? We believe the premium spread in private credit really comes from self-origination, and we'll explore this more in our conversation with Art shortly. But essentially, this is where private lenders with capital are sourcing, diligencing, structuring, negotiating, and holding to maturity their own loans. They're leveraging an informational advantage, often an existing relationship, and flexibility of capital and terms to generate that superior yield. The chart on the left here shows the yield premium on broadly syndicated loans over treasuries. Broadly syndicated loans are corporate loans to sub-investment grade borrowers, typically generating over $100 million a year in EBITDA. Through direct origination, the equivalent risk asset in the private credit world is the next column over, the directly originated upper middle market loan. So also $100 million a year EBITDA borrower, but through origination, you're able to get a 250 basis points yield premium. Naturally, as you go up the risk spectrum, you get a bigger spread. For example, when you start lending to non-private equity sponsored borrowers, you get a premium. And then again, to non-sponsored smaller companies, you get a further premium. There may also be a perception that smaller is riskier. And for those who have been on our calls or spoken to us previously, we've often shown data that hasn't quite played out historically in private credit. The chart on the right shows lower historical losses for mid-market companies compared to broadly syndicated loans, resulting from a lower default rate. Overall, notwithstanding the market volatility that we've seen in share prices, which we took advantage of over the past 18 months to really rotate the portfolio into oversold situations, we're pleased with the returns and the stability of income achieved today. I want to leave you with 3 takeaways today. Number 1 is that the income from the Barwon Global High Income Fund has been consistent. The current underlying yield of our holdings is about 8%. It's come down from a historical average of about 9%, due mainly to a lower base rate and spreads, but still remains very attractive. The second, notwithstanding the volatility, we believe the underlying assets are defensive. We're diversified across over 2,000 underlying investments or loans. And today, when we look through to the underlying portfolios, the credit quality and the liquidity of borrowers themselves is better than ever. And finally, our fund offers monthly liquidity, exposure to a portfolio of floating rate, self-originated private credit assets, which we think provides attractive income in today's low rate environment. And with that, I'm excited to bring on Art Penn, founder and CEO of Pennant Advisors, manager of the listed private debt fund called Pennant Investment Corporation, a long-term holding in our fund, and a veteran in the private credit sector. So welcome, Art, and thank you for joining us. We really appreciate your time today.
Thank you. Pleasure to be here this morning, which is this evening in New York. But thank you for inviting me.
Terrific. Well, firstly, how are things in New York? We're all stuck still in lockdown here, so we're always keen to hear how the rest of the world is getting on.
It feels like things are normalizing in New York. Not normal, but normalizing and moving to kind of the world the way it was. People are still, by and large, not coming to work as much in skyscraper office buildings. So the office building that I'm in right now might be 40% occupied. But if you walk around and want to have a meal or want to have a get together, things are very open. So it's kind of a mixed hybrid scenario at this point, but things are by and large normalizing, and hopefully we're well on our way to that end.
Glad to hear it. And look, I might just jump in here and just remind our viewers and those who joined us on the call that we would encourage you to ask questions. So there's a chat box in the webinar software. So please put your questions in there, whether it's for me, Bob, or for Art. But Art, thanks for joining us. And I mentioned in the intro that you were the founder and managing partner of Pennant Investment Partners. Can you give us a very quick summary of your personal background and how you came to set up Pennant?
Sure. I've been in the, thank you, James, and thank you for inviting me. I've been in the industry a long time now. I started out in 1986 at a firm called Drexel Burnham, which was known as a leading, high yield underwriting firm in the day. And after Drexel Burnham, I had jobs running high yield groups in various investment banks on Wall Street, Bankers Trust, UBS, Lehman Brothers. I then was at Apollo for a while, where I co-headed the credit business at Apollo, and then started Pennant Park. I spun out of Apollo in 2007 and started Pennant Park then, and we set up Pennant Investment Corporation, which is one of our publicly traded entities, which at that point was doing mostly second lien and mezzanine debt, kind of the middle layer of the capital structure, to private companies. Over time, that vehicle has grown and morphed, and we've created other vehicles. We have another publicly traded BDC called Pennant Floating Rate Capital, and we have a variety of different vehicles, commingled funds, CLOs, joint ventures, and SMAs. So we have a wide variety of different vehicles to that package the loans that we directly originate, and we directly originate loans from at the top of the capital structure, first lien senior secured floating rate loan. We directly originate in the middle of the capital structure, mezzanine, second lien, subordinated debt. And we also originate equity co-invests, where we can give some of these portfolio some lift and some upside co-investing in the equity of these companies.
Right. Look, that's a really helpful sort of intro and background. Now, in the audience today, there are probably some who may not have had a long history with private credit. So I guess, how do you define direct lending, and then perhaps how has it evolved over the years that you've been involved in the lending space?
Yeah, great question, and Bob alluded to it a little bit in his comments. Once companies get to a certain size and scale, they can hire underwriters to efficiently syndicate and sell their credit, their loans or their bonds, to the liquid markets. And the liquid markets, by definition, are for bigger companies, and as a result, the yields are lower, the covenants, the protections are weaker, the leverage is higher, and the lenders don't really have a direct relationship with the borrower, so they're not doing their own due diligence. But those loans are liquid, and there's a wide variety of investors who buy into those liquid loans and get, what they think is attractive risk-adjusted return. Direct lending, the name direct lending, comes from the fact that we, in most cases, have a direct relationship with the borrowers. We're doing due diligence on site or on videos. We're getting to know them. We develop a long-term relationship. We negotiate covenants that protect us as lenders. When there's financial information, i.e. monthly, we get monthly financial statements. So we are kind of with them at all stages, and we take our time to carefully underwrite and diligence what we are buying. And typically, as Bob said, that means companies below a certain threshold. To certain of our peers, it's companies below 100 million of EBITDA, because that's where they think they can get attractive risk-adjusted return. For Pennant Park, we see better risk-adjusted return below 50 of EBITDA, and we're even seeing better risk-adjusted return 20 million and below. And to Bob's point, if you look at the statistics over a long period of time, just because a company's smaller doesn't necessarily mean the risk-adjusted return you're getting as a lender is worse. In fact, if you look at the data, because the diligence is stronger, because the covenant protections are tighter, because the information flow is higher, because typically the equity support beneath the loan is greater, the outcomes have been better. There's been fewer defaults, and when there have been defaults, there's been higher recoveries. So where we're seeing the best risk-adjusted return in the marketplace today is not only below 50 of EBITDA, but it's below 20 of EBITDA. And that's where we've had our most recent successes, is lending money to those companies in what we think are safe loans, A, and B, in many cases, we can co-invest in the equity. When we can co-invest in the equity, our debt is driving the growth from, let's say, 10 or 15 of EBITDA to 30 or 40 or 50 of EBITDA, and our equity co-invest is generating an outsized return because we're capturing the upside of that company as it grows. So that's kind of where we're focused today. That's kind of our special differentiated edge, is kind of focusing in on those kinds of situations.
Great. And so you've given us a good bit of color in terms of where you sit in the ecosystem and where your area of focus is size-wise. What about sectors or industries? Do you have any specific sector or industry focuses?
Yeah, that's a key way we manage our risk. Is we want to make sure we're among the smartest people in the room when we're looking at a credit. So the 5 key sectors where we've spent a lot of time where we have a good track record are government services, healthcare, technology, consumer, and business services. So those are the 5 key sectors, which basically represent about 85% of the deals that we're doing. So when the deal comes in and fits one of those sectors, we know very efficiently whether it's going to work for us or not. And we know the right questions to ask. And that way we can protect our capital.
Interesting. We've seen the space grow a lot of the big growth in AUM, new entrants to the market. What are you seeing in terms of the evolution of the competitive landscape, and what might some of the barriers to new entrants be? Why doesn't everyone do it?
Well, it's the new entrants tend to be, if there are new entrants, they tend to be teams that have successfully invested in the asset class in the past, that are spinning off from a bigger firm. I spun off out of Apollo as one example. So the competition, when there is new competitors, and I'm putting that in air quotes, they're not necessarily new competitors. They tend to be people that we've invested with in the past, side by side. They tend to be rational by and large with how they price their risk. And there are new competitors from time to time, and that's okay. There's nothing new in that. I mean, that's always the case in our business. There's always a new competitor. The question for us is, can we get the first call, and can we get the last look when we're trying to get a deal? You know, can we get that first call, and can we get the last look? And that is based on a lot of different elements. Incumbency is one of them. Incumbency means where we are a lender to an existing company. So today in our portfolio, we have about 140 different companies across the Pennant platform that we're currently lending to. We get monthly financial statements. We know exactly what's going on with those companies. And inevitably, there's always flow coming from the portfolio. What we like about that is we have perfect due diligence. We're already in the name, A. And B, by definition, we're going to get the first call and the last look so that we can retain that asset if we like it. If we don't like it, we can let it go and somebody else can lend to that company. So having incumbency is a key competitive edge. Also, having been in the business for as long as we have, 11 of us on the investment side have an average of 24 years of experience in the industry. So everyone knows who we are as individuals and as a firm. We know them. We can handicap behavior, et cetera. They can handicap our behavior. And really, for our borrowers, what's most important typically is not whether they're getting the cheapest pricing. Most important to them typically is how we are going to behave if something goes wrong. Because remember, we have covenants, typically quarterly maintenance tests, that they have to abide by. What's the debt to EBITDA each quarter? What's the EBITDA to interest each quarter? And if they blow a covenant, then we're at the table. And how are we going to behave, and how are they going to behave? So if we're doing it right, it's never about the last few basis points. It's typically about a long-term trusted relationship that you've built over many years and many deals. So lots of ways to compete. We do it by our experience, by our relationships, and by our incumbency. And also staying in a zone below 50 EBITDA and below 20 EBITDA, where the competition is less, where our capital can be more important, where because our capital is more important, we can drive the terms in a much more successful way.
Great. Well, thank you for that context and painting that landscape. I think it's a good point now to perhaps bring it to life using the experiences over the past 18 months. And I'm curious to hear how's your portfolio performed over the last 18 months, and were there any sort of proactive actions in portfolio management that you had to take to get in front of issues that you foresaw?
Yes, look, the COVID experience was, as you know, a searing experience. We're still not through it, of course, but that first few months of COVID, when basically the global economy was shut down, was a searing experience for, I'm sure, all of us to some extent. And we all had to look around the portfolio and these companies and say, okay, what are we going to do to get through this time period? How are we going to help? What actions needed to be taken to protect and preserve? And in those 3 or 4 first months, there were a variety of different outcomes, a variety of different impacts, and a variety of different behaviors that we saw. By and large, the portfolio came through COVID in really good shape. I think part of it was the lessons that everyone learned from the global financial crisis. If you go back to the global financial crisis, the people, the sponsors, the companies, the management teams, and the lenders who took deep action quickly tended to perform better throughout the global financial crisis than those who did not take action or those who were slow to take action. So to a company this time, most of these portfolio companies took quick action, whether it meant cutting costs, managing their working capital, putting more equity in into the companies, cutting the management fees from the standpoint of the sponsors, sitting down with people like us to say, how could we fix a capital structure that might need a short-term fix. So as we looked at the 130 at the time companies we had in our portfolio, it was a very rapid, swift, and deep action that was taken by and large. As a result, across those 130 companies, we only had 4 defaults, which is kind of remarkable through COVID, which is kind of, you'd say, 4 defaults in 130 names. That would be a normal default ratio in a regular environment, much less COVID. And we really attribute that to the swift, deep action that everyone took, during that time frame. And you look, of those 4 situations, 2 of those companies resulted in us, as you said, Bob, converting debt to equity, and we now are controlling shareholders of those 2 companies. 2 of those companies we did not have to take control, and those companies, and all 4 companies are on the rebound. It's just a question of what those capital structures look like, at this point. So, pretty strong, very strong performance through COVID, and I think it really was kind of due to the lessons that we all learned from the GFC.
Absolutely, and as you say, Art, where at least you're in control of those workout situations from this point as well, and that's an important factor in mitigating, in increasing that recovery rate when things do inevitably go wrong.
Yes, there's some people kind of think, well, if a company defaulted, that means it's worth 0. And in fact, that could be the farthest thing from the truth. It's really just a question of what the capital structure looks like and then how things are going to play out. In many of our defaulted situations, we end up converting debt to equity and we make more money and we have returns better than we would have had if the company had not defaulted. So it really just depends on the circumstances and how the company rebounds, how the company's managed, and where we are sitting in the capital structure. If you look at us over the course of time and our recovery ratio, it's been about 80 cents on the dollar, and we've had very few defaults. So as you look at that, what that means is on our senior loans, we have about a 10 basis point annualized loss ratio, which is kind of very small when you consider typically senior loans yield 8% or 8.5%, having 10 basis points loss on an annualized basis. And when you look at it kind of across the capital structure, including our subordinated debt, that's meant about 30 basis points of annualized losses against yields of 10 to 12%. So we've had very minimal defaults over time and very high recoveries.
I think many of us on the call would agree it's too early to use the term post-COVID, but with the market recovery and asset prices recovering so strongly, with spreads coming in and default rates low today, can you just talk a bit about how deals are being underwritten in today's environment, generate the same types of return?
Yeah, it's a good question. Look, we think this post-COVID vintage will likely be very strong. We use the term vintage. Most people think vintage relates only to wine, but it does relate to investments, particularly private illiquid investments. So we talk about the 2021 vintage and what's the 2021 vintage going to generate. And we think it's going to be a really good vintage because it is post-COVID. By and large, the companies that we're financing by definition, are strong companies. They're companies that made it through COVID, in really good shape. Leverage levels are reasonable, yields are attractive, covenants are relatively strong. So we're fairly enthusiastic about this vintage. And the economy's by and large rebounded. Now we have some risks which kind of come out of a good rebound, and we all talk about them. There are supply chain issues because demand is so high relative to supply chain, where production gets created, where transportation and logistics to the ports. So there's supply chain issues coming from a robust demand relative to the supply. And there's labor issues, right? So another form of cost where there's very robust demand and there's kind of a labor shortage. So the cost of labor is increasing, all of which kind of conspire to create this potential for inflationary pressure. Because the cost of goods are going up. One of the things that's nice about this asset class that we're involved in direct lending is the vast majority of the assets are floating rate loans. So to the extent inflation is increased, which generally means interest rates will increase, by and large, this asset class is protected because the loans float over a risk-free rate.
Very interesting.
Look, I think you've given us a great bit of colour into the real value in that direct origination and that relationship with the borrower, because I think for us that's the really clear differentiator there that adds that value. Bob, unless you've got any burning further questions, we might open it up to the audience and so I encourage the audience, please post your questions in the chat box. Now, the first couple of questions we've got, which are related, and I'll be interested to get your take on this, Art. The first one is, do any of the listed debt funds have exposure to the Chinese property market? And what's going to play out there, and how's the Evergrande situation going to affect the debt market? Now, first thing, I'll kind of take the first bit there is, certainly the listed loan funds that we're investing in, no, they don't have any exposure to the Chinese property market. I think, given the context Art's just provided in terms of the structure of these loans, the direct originations, the relationships with both the companies and the sponsors, that's really not the style of loans we're looking at. So no exposure of that type there. But I guess on the broader question, Art, do you have a view on what the Evergrande situation might mean more broadly for global credit markets generally?
It's a great question. Look, we have not lent to companies in markets like China ever, because we only want to lend where we as lenders are in a jurisdiction where there's a rule of law that's consistent and credible, where we can handicap our rights if something goes wrong. So, where there's a regime that's understandable for bankruptcy. So we can understand if something goes wrong, we can take it through bankruptcy and understand the outcome. So the United States, Canada, Australia, New Zealand, UK, parts of Northern and Western Europe, and that's basically it, So that's obviously we are 98% US. We have a little bit of Canada. And that's kind of been where our focus has been. We're certainly open to areas like Australia and otherwise, but we need a consistent rule of law that we can bank on as lenders, where we know what our rights are if something goes wrong.
Oh, great. The next one we've had come through, and again, I'll talk about this from our portfolio perspective, then I'd be interested from your Pennant Park perspective. The question is, what is the dollar value or ratio of loans secured by first lien versus loans secured by subordinated debt? Now, we'll look through basis in our fund, the Barwon Global High Income Fund. It's about 90% first lien, with the remainder being in subordinated and some small equity positions. So what about across your Pennant Park platform?
Yeah. So look, we have two strategies. One strategy is directly originated senior debt, and that's about 60 to 65% of what we do today. We have other strategies that we call across the capital structure, where we're not only doing first lien debt, but we're doing some second lien mezz and a little bit more equity co-invest. So those are the two strategies. We have a variety of different vehicles that play in those two strategies. It's really up to the investor, which strategy they like. The across the capital structure strategy is a higher return, higher yield strategy by definition, and it's taking a little bit more risk.
Actually, just to follow up on that, I'm curious, where do you see the relative value in today's market between subordinated and senior?
Look, I think in my earlier comments, we believe the best place in the market today is doing senior debt of these smaller companies where we can get this equity co-invest. Because then to some extent, we're getting the best of both worlds. We're getting a very safe senior loan instrument where we can sleep at night. And that's what our investors want. They want capital preservation and a yield, and this ability to create some upside optionality on the equity co-invest, because our debt is fueling the growth of these companies. So we're not doing much in the way of subordinated mezzanine, second lien debt at this point. Selectively, when deals come in and they really are strong deals, we will do them. But as a general proposition, we'd rather do the sub $20 million EBITDA companies and get the increased return that way.
Yeah, great.
Another one coming from the audience is, what's the typical life of a loan in your portfolio? And I guess in that, is early repayment a common experience?
Yes, it's early repayment is, if we're doing our job and underwriting correctly, the company's leverage will go down, over a 2 to 3 year time period, and they'll either refinance the company or the company will be sold in some way. So the average life of our loans is 2 to 3 years. The contractual term is 5 to 7 years. So we go into the loan saying it's got a contractual maturity of 5 to 7 years. Typically, it's a 2 to 3 year life.
Right. Another one here is that you mentioned that the fund or the invests, or that Pennant Park invests in a company's debt and equity. And I guess the question there is there an inherent conflict of interest here, and how do you manage that?
Yeah, it's a great question. So by and large, 90 to 95% of what we do are the debt investments. The equity would be the 5 to 10%. So we are primarily a lender. That's our mission: protect, preserve capital, generate a healthy yield. Primary mission, number one. The equity co-invest just gives us a little upside optionality. And yes, if the company runs into trouble, we're focused on preserving our capital on the debt side. We understand the equity, will get marked down.
No problem. There's a strong question come through here just around the BDC market generally, saying the risks of BDCs can't be that trivial, considering there has been a history of BDCs which haven't performed as well as would have been hoped. And there have been a number of these instances. I guess how can how does this happen, and how do we pick stocks, I guess, is the other side of that. So I might touch on this first myself, and then Bob and Art, if you've got anything to add. I mean, clearly, if you're lending and you're lending to smaller businesses, it is not without risk. And our view is that really comes down to manager quality, manager skill, and being in the right capital structures. So, this is not to say the BDC market or listed BDC market is a risk-free 8 to 10%. That's clearly not it. But what we're trying to do is build a diversified portfolio of quality managers who are putting together directly originated books of loans that are well diligenced and have good covenants. So, for us, the focus is really on quality, and that's how we look to avoid those situations. Now, Bob, I don't know whether there's anything else you'd like to add in the context of the listed BDC market.
Look, I think you're absolutely right. Track record, ability to navigate, portfolio construction. These are all important elements that investors need to understand. You now have a bunch of BDCs who've managed through COVID generally pretty well. Some of us have managed through the global financial crisis, a different kind of downturn pretty well. So there's some very experienced management teams out there who have strong track records.
Yeah. I would just perhaps just add my final thought would be that I appreciate the question, and I think the dispersion in performance across the listed BDC market is certainly much greater than we as investors would like. I think that over time, and certainly over the past 5 or 10 years, we've seen the manager quality and their approaches to, as Art was referring to, origination, portfolio construction, risk controls, I think is always improving and in many ways institutionalizing. And so absolutely recognize that there is a dispersion, and that's why we think that active management of a portfolio is critically important, being able to identify the right managers and platforms to back, and so that's what we're focused on. But hopefully, and it is our belief that over time, the dispersion that you see will hopefully, and particularly on the downside, will hopefully narrow.
But just in the interest of time, given it's coming up to 10:18 now, we've gone through 45 minutes. We might bring it to an end there, but I'd really just like to say thank you to everyone who's joined us today on the call. We really appreciate your time and value you joining us. Thank you, Art. Really appreciate you staying in the office late on a Monday evening in New York, and really value your insights. And so thank you for that. Now this has been recorded, so please feel free to pass. You'll receive a link to the recording. Please feel free to pass it to your colleagues if you think they might find it of value. And if you have any questions about the Barwon Global High Income Fund or our strategy more generally, please do get in touch with us when suits. But on that note, thank you, Art. Thank you, Bob. Thank you all for joining us.
Thanks, Art. Thanks, everyone.
Thanks, everybody.